In this session, we will look at off-balance sheet risk. Generically, off-balance sheet items refer to those transactions undertaken by a financial institution that are not required to be immediately reflected on the liability or the asset side of the balance sheet, but could potentially impact the balance sheet in the future. Such transactions are also referred to as below the line or contingent assets or contingent liabilities. Let's look at the nature of off-balance sheet exposure, including the instruments that contribute to this exposure and the nature of risks embedded in such transactions. First of all, commercial letters of credit. Commercial letters of credit, LCs for short, are widely used in domestic and international trade. As you might recall from one of our earlier sessions, the buyer, that is the importer, approaches his bank, which is called the issuing bank, to issue an LC, which in effect is a guarantee for payment by the issuing bank on the due date on behalf of the buyer, provided goods are supplied or services rendered as per the description in the letter of credit and as per the terms specified therein. The issuing bank is paid a commission upfront by the buyer for issuing the letter of credit. This transaction is treated as an off-balance sheet exposure by the issuing bank until the date when the payment is to be effected as per the terms of the letter of credit. May I reiterate, the issuing bank is obligated under the letter of credit to effect the payment to the seller's bank or the exporter's bank on the due date, irrespective of whether the buyer, that is the importer, meets his payment obligations on or before the due date. In case the buyer, that is the importer, defaults on his payment obligation, it will devolve on the issuing bank and hence it becomes an on-balance sheet exposure for the issuing bank. Such instances of default are few, roughly 10% of the total value of LCs issued by any bank. Given the propensity to earn a high fee income in the form of commission on letters of credits issued and the low probability of default, banks have a strong motivation, perhaps even a perverse incentive, to issue letters of credit that are large both in terms of value and in terms of volume. The second off-balance sheet instrument is guarantees. Guarantees are similar to commercial LCs but not necessarily trade related. These include, for instance, a performance bond issued by a financial institution, which is referred to in the context of guarantees as the debtor, issued to the government, which is known as the creditor, for say timely and satisfactory completion of a road construction project undertaken by an infrastructure company, which in this case is referred to as the reference entity. In the context of guarantees, the bank earns a fee income upfront from the infrastructure company for issuing the performance bond on its behalf. 2. This performance bond will be reflected as an off-balance sheet item in the books of accounts of the bank that has issued the performance bond. Should the infrastructure company fail to meet the quality and time deadlines as per its contract with the government, the performance bond will be invoked by the government, at which point the bank that has issued the performance bond will be called upon to make good the loss. The amount so paid to make good the loss when the government invokes the performance bond will then become an on-balance sheet risk in the books of the bank that has issued the performance bond. Otherwise, on successful completion of the contract, the performance bond will be revoked and the associated off-balance sheet risk will fall away. The third type of off-balance sheet item is credit enhancement. Credit enhancement involves a financial institution standing guarantee against potential payment defaults. For example, by a firm that wishes to borrow in the commercial paper market. Please recall our discussion in an earlier session that commercial paper is an absolutely unsecured instrument, and hence without the credit enhancement, the borrowing cost or the discount rate for the firm issuing the commercial paper would be significantly higher. So, starting from the issue date of the commercial paper, the value of the commercial paper issued under the credit enhancement will be reflected as an off-balance sheet exposure in the books of the financial institution that provides the credit enhancement. Should the issuer of the commercial paper default on his repayment obligations, such defaults will have to be made good by the financial institution that provides the credit enhancement, and the amount so paid will move from being an off-balance sheet item to an on-balance sheet item in the books of accounts of the financial institution that has issued the credit enhancement. Should the payments be made in time, in full, by the issuer of the commercial paper, the off-balance sheet exposure will fall away on maturity. In either case, remember, the financial institution earns a fee income upfront from the issuer of the commercial paper for providing the credit enhancement. And finally, the most interesting off-balance sheet instrument prevalent in contemporary financial markets are derivatives contracts such as forwards, futures, options, swaps, etc. Financial institutions use derivative contracts either to hedge against risks, particularly interest rate risk and foreign exchange risk, in their own trading book, or act as counterparties to their customers in derivatives contracts. Let's look at a very simple example. Consider a call option whose maturity date is 30 days hence. Until the maturity date of the option remains an off-balance sheet item in the books of the seller of the call option. If the buyer of the call option does not exercise the option until the maturity date, the off-balance sheet risk falls away. On the other hand, if the option is exercised by the buyer of the option, then it becomes an on-balance sheet item for the seller of the option. In either case, the premium received in the option is treated as a fee income and reflected accordingly in the income statement of the seller of the option. Now, there is a very all-pervasive risk which manifests itself as an off-balance sheet risk, and this goes by the name settlement risk. As we've already seen in an earlier session, every transaction in the financial market has two significant stages. The first stage, when the trade is executed on the trade date, and the second, when the settlement or the transfer of assets is effected as per that trade on the settlement date. So remember, there's a trade date and there's a settlement date. Between the trade date and the settlement date, every trade is reflected as an off-balance sheet exposure by the counterparties to the trade in their respective books of accounts. This is necessary because either party could default on its settlement obligation on the settlement date. So, on the settlement date, if the settlement is effected in full by both parties, that off-balance sheet exposure falls away. On the other hand, if one of the counterparties to the transaction defaults, then the amount in default becomes an on-balance sheet risk for the other counterparty to the transaction. That means who is suffering because of the default on payment by the other counterparty. Since participants in the financial markets have several transactions settling concurrently involving cash outflows and cash inflows, failure of even one entity in any financial market could have a contagion effect on the entire system, rapidly turning off-balance sheet exposure to on-balance sheet risks for several institutions concurrently, as was witnessed during the 2008 crisis.